of the auction, of the volume profile. And so again, things like low volume area. Low volume areas are unfair prices. They're places that buyers and sellers have shown they're not interested in doing business. Price is either going to bounce hard off them or they're going to come through like a slingshot. If they come through like a slingshot, it's typically, I can't say every single time, but typically going to be associated with a large volume spike. And here's and you're going to learn this, but here's a good indication. If we get price that moves through a significant low volume area and there's no volume spike, it's most likely a stop run. It's most likely a stop run. Price is going to come back, and we'll eventually get that bounce. But it's most likely going to try to stop us out. So high volume areas, it attracts price. It's a magnet. We get rotation. The price distribution, that bell-shaped curve, occurs because buyers and sellers see a fair price. They're willing to engage, and when buyers buy at that point, then they start selling and they taper off. When sellers engage at that point, then they become buyers and they start tapering off. All of it means is that that fair price, that high volume area, keeps attracting more and more business. More participants are willing to enter at that price, both long and short, than any other price in the distribution. We'll also see as a characteristic of that price distribution, low volume area at the top, low volume area at the bottom, and a high volume area in the middle. So different elements and attributes, as we start getting into examples here, it's going to become more apparent what those things mean. So defining the rotations, again, this is how we're getting into now how the order flow and the auction starts to create the volume profile. The dual auction, price going up and down, price going up, price is too high. It's the example of the football, Super Bowl tickets, price is too high. Sellers step in, excuse me. Okay, sellers step in, they start engaging, they bring price back down because value is lower. It causes rotation intraday. And once you understand that and you can start to define what those rotations are, what they're most likely to be, you can effectively trade those distributions. Every rotation, up and down, has an associated volume profile. Those different rotations are driven by different market participants. And the volume profile with each small to large rotation provides the insight for low risk, high reward trading opportunities as I identify fair and unfair prices. And finally, they also show buying and selling interest between the buyers and sellers across various swings and time frames. So what does all that mean? They're all great words, but what does it mean in a chart? What does it mean to us as traders? Get rid of these two profiles here. Okay, let me go back to this. And I built a volume profile as price started moving up to this swing high and just beyond it. And I can start to identify low volume areas. Here. I see VPOC. And what I want to start to do is identify low and high volume areas. So as price starts moving beyond these levels, so for example, here's a low volume area here. So I'm going to try to blow this up so you can see it. I've made these bars very light for a reason so that the volume profile kind of sticks out. But I made this volume profile up to this date. And you can see that right here. So now on subsequent days, what I'm looking for is, and actually that goes up to about right there. See that low volume area, the high of that? We have a range of low volume from here to here, but if I'm making a trade, I may have to get in right in front of this low volume area, but the safest trade, best risk reward is right here, because if price comes, if I get in at this level or right here, And I'm looking over here. If I get in here, my risk is pretty small. I'm out if it comes above this level. Whereas if I get in front of this low volume area, I have to give it a lot more room before I know I'm wrong. So this is the level that I'd be interested in. I've made it up to this point. Let me do this. Okay, there is my line. And now I'm trading, looking to trade the next day. And I have this low volume area, right? I can see that right here. And what am I doing? I'm looking for a short up against this area, right? Because price has come down below it. I'm looking at this now because price is in this distribution right here. I'm looking at this as an unfair high. Buyers need to push through hard with a lot of volume and maintain that. So once they get price through, I need to see an intraday volume profile growing in volume above it. They need to maintain their efforts above this level. But otherwise in the market now that we've come through this area, this is now an unfair high. And this is an unfair low. But this is my distribution. This is the distribution of price that I'm in. And what I'm looking for the next day is a short right here. And what you can see is price came up to 65.25, up to 1 point, and then came down. Not only did it come back down to this low volume area, but came down through that low volume area. And then look what happened. This is one of the things that I talked to you about. You see this volume point of control right here at 53? Everybody see that? That yellow line at 53? It's faint, but can you see it there? Yeah, okay, good. Once price came through this level and came back up, remember what I told you about high volume area or volume point of control? When sellers can't get price through that area or buyers can't get price through that area, what did I tell you would happen? Likely to go very strong in the other direction, right? Why? Because when you think about the auction, that's why everything to me is about the auction. When you think about what's happening in the auction process right here, up to this point, these buyers and sellers have shown that this is the most fair price. Now price comes back up above it. It had already rotated down, which is exactly what I expect. I expect rotation through a high volume area, back up through it, comes back down to it, right at this level, and bounces off it with responsive buying, right up through that low volume area. And what's happening in the auction here is when sellers don't have enough conviction to push price through what they have considered to be fair price, then look out above. It's the same thing on the other side. When buyers don't have enough conviction in a day to take price through VPOC, fair price, then look out below. What it means is that this low volume area is at risk. Most likely is going to be broken. And so the trade I would look for is price to come through. You see how it bounced off? I would look for price to come through. Show me the conviction. You see how it came right back down to this level, and this would be my long. Why is this my long? Because this now, when price moves back above it, this now becomes an unfair low. Unfair lows, I'm looking for a long. And what you can see happen right here, price came right back down to that level, and what happened to it? Took off. So once you have gone through the elements now, and again, we're going to go through this over and over and over again. You've gone through the elements now. You understand to some degree the attributes of those elements, and you understand low volume areas, unfair highs and lows. It's one of the reasons why we look for trades around those levels. Price moving back to fair price, right? Here's the most fair price of this range. You can see all kinds of rotation around it. Does it make sense what I'm telling you? Price comes down, comes back up. You can see the short off of this level, all the way back down through it. We're rotating. It can't get through. Thank you, David. It can't get through. And if it can't get through here, sellers are, look what happened here. When sellers are saying, we don't have enough conviction, we're not willing to spend the money. Remember, sellers have to take less in order to make a market order, and market order is the only order that can move price. They're showing they have no conviction to get price through fair price. And so what that's saying is we don't consider this to be fair price. If we don't consider this to be fair price right now, then we are most likely going to relent, and we're going to wait for another area to be fair price before we re-engage. And it's not likely going to be this low volume area, this unfair high. They're most likely going to wait for this area. So price came back up, it came through. Here's our long. This would be the first place we're looking for a short. There's our short. Boom. Came down all the way through. We get some rotation around volume point of control. Sellers once again said, nope, don't have enough conviction. I'm not willing to put my money here. I'm not willing to create more market orders to take price lower. That's big red flags that say sellers lost conviction. If sellers lost conviction, I expect them to find a new area to engage. And it's not likely going to be this area. Good, I'm glad this makes sense. I'd like opportunities outside of value. Am I too strict? No, I don't think you're too strict at all. I just think that you need to understand, not understand, but apply the context of value relative to your trades. And it sounds like in that case you would like to be taking trend trades, right? Because as the market probes outside of value, it's pushing. It's pushing either higher or lower. And that is typically a trend. And what you'd be looking for in that case to support further movement is you would be looking for value to keep moving lower with the move. Let's see. So would I reverse at that level for a short right here? Yes, this is where, right here is where I would look for my initial short. But I would need the print to confirm. The print has to confirm that, in fact, buyers are stepping away and sellers are stepping in. And remember, I look down one or two levels to see if that holds true one or two levels below, because a lot of times what I'm going to see in the print, let me show you. A lot of times what I see in the print, buyers and sellers are tricky, is let's say I have an area right here where I want to short, and I see the weakness at the offer and strength at the bid. I'm like, oh, that's awesome. That's what I'm looking for, right? And then below that, I'll see buyers pushing. This is an example here, but I'll see buyers pushing and weakness at the offer. I'm looking at that going, well, it could work, but if I start getting, I could take the trade, but if I start getting any strength back into the offer at 30.25, 30.50, I'm out of this trade. Because I have active buyers right here. And for example, if there were weaker sellers, if we had weakness to the offer, which we don't in this case, but we have weakness to the offer below this perfect, what looks to be a perfect setup, I'm a little bit weary, right? My job is to manage my risk. That's my number one job. And as I do that, I have to identify where buyers are. If I'm looking short, are buyers really relenting? And so I better start to see weakness or a lot more strength in the bid. And it doesn't mean the trade won't work. All it means, if there's strength at the offer, weakness at the bid below this level, is there's additional risk in the trade. And I just have to understand that so I can watch for it and manage my trade effectively. Does it mean that sometimes I'll get out of a trade and it'll still work in my direction? Absolutely. That's exactly what it means, and that happens to me. I won't say a lot of times, but it happens to me. And I believe in trying to take a trade to its fullest advantage, its fullest extent and range. But I also believe, and we're going to talk about this on Thursday as we start talking about trade plans, actually end of day tomorrow and into Thursday, as we start talking about trade planning, is as you are trading through the day, you really need to understand what is your profit objective for the day. Now everybody's different, and I can't ascribe to you, and some people have asked, actually I get a lot of questions like, well, if I have an account of $10,000, what should my target be for the day? How much money should I be making for the day? How much risk should I take for the day? Well, I can give you some standard numbers, but irregardless of that, you should inherently understand what you're willing to risk in a day or a week and how much money you need to make for your trading business. So when you walk into a day, you inherently understand, today my profit objective is $300, or today my profit objective is $3,000. You understand the context. For example, we're into August, and we're moving into what I call the dog days of summer in terms of the ES and price movement. And we don't get as much price movement. So that means if my profit target is $1,000 a day, I'm likely not going to get that much range. So I'm probably going to have to up my contracts in order to make that much money. Or I can move to something like oil that has more volatility, but also offers more risk because of that volatility. So I have to make a decision about how much I need to make, how much I'm willing to lose in that day, and when I hit those targets, I'm done. And if my target for the day is 500, and I get into an ES trade with 3 contracts, and I'm going long, and it goes 2 points, I get in with 3, goes 2 points, and I see all of a sudden it gets really weak at the offer, a lot of strength coming in at the bid, and let's just say it's a key level. Well, I'm either closing that trade and taking that $300, or I'm taking 2 off and seeing if the other one will run. Because if I know my goal, my objective is $500 for the day, and I have 300 or less, just under $300 in a trade, say 275 in a trade, I only need $125 for the remainder of the day. Now I'm looking at 2 contracts in a trade, looking for 5 ticks. That's a lot easier to get to, and I've met my target. So one of the things we're going to talk about, and this is really important, understanding what your profit objectives are so that you can manage your trades to your profit objectives. So that what you can do in your trades, if the print is telling you there is additional risk to the profit you already have locked in, risk to your initial trade, then you can effectively manage that risk and do it objectively. But if you have no idea what your objective is for the day, and it might be $200, might be 3, 5, whatever it is, or what your risk tolerance is for the day based on some kind of business plan, there's a really good chance, there's a high probability that your account will continue to dwindle. So what we're going to talk about is, right here, as I have an opportunity for a trade, and that may be long, I would have to look at this and say, where are the 2 areas long that this price is likely to go? 59, and here's another higher volume area here at 62, 62.75. If I'm looking for 500 in a day, and I'm looking to take a long off of this level at 56.75, unfortunately, I'm going to look at the print. If the print tells me that things are stopping here, I'm going to have to take some off. That's okay though, because I'm looking for potential of this area and potentially this area with 1 or 2 remaining contracts to get me to my 500 or closer to my 500. Does that make sense? And what I can tell you is the more that you can begin to align your profit objectives for a day and have that in your mind and what it takes in terms of number of contracts and points, ticks to get there, the more that you can do that, the better risk manager you will be, the more objective you will be, the better that you will manage your risk, and you are more likely, once you get into a scenario, you're making profit, take the 3 contracts, you made 2 points, and all of a sudden the print tells you, whoa, buying is done, we got more selling coming in. You now, instead of going, man, I hope this continues, you can make a conscious decision and say, okay, I would expect a pullback. I'm going to take 2 off, and I'll look for a pullback to this area. If it continues, I could add back into this trade 1 or 2 contracts. My ultimate target is this. And so you can start making decisions to take your profit, minimize your risk, and help yourself, give yourself a much better chance of achieving that objective for the day. And managing your risk. And again, we're going to talk about this when we get into psychology, and I'm going really long here today. I'm sorry for that. But when you get into a trade and it looks like it's starting to work against you, and it's your first trade of the day, tell me that isn't a killer to your psychology when your first trade of the day is a loser. And now you know you got to make $500, or you want to make $500 and you're down 150. Tell me that it isn't a killer to your psychology. But if you get into your first trade and it looks like it's starting to move against you, your risk is higher, and you get out of that trade for a 1 or 2 tick loss. So let's say you're down 50 instead of 150. You walk into your next trade going, yeah, I managed that trade pretty well. Even if the trade worked in your direction, if the trade starts working in your direction, you have the objective mindset to be able to get back into that trade, and you know where it's likely to go. I usually kick the dog. All right, so we're going to talk about that when we get to psychology. Like I said, I can, unfortunately, and I told DB this, my issue as a trainer is I can talk all day. So I want to get onto the content and respect people's time. So those are the rotations, and that's how we start to use volume profile as it develops. The next thing that I would do in this, there's my volume profile. Next thing I would do is, let me scrunch this up a little bit more. As price is moving up and down, I would continue to build volume profiles as price moved higher or lower. And what I would start to do, you see this volume profile has VPOC here at 71.25. This VPOC is here at 52.75. What this is telling me is this market is accepting higher prices, and so the potential is still higher. So I'd keep building these profiles. I would also extend this profile all the way out to the current date and start looking at how the market structure is changing. And then I would look for areas like right here where there was confluence across these areas, low volume areas, high volume areas. I'd look for confluence, and I would keep building these out. And these swings are just different time frames. But everything I'm showing you, this is a 3-month chart. Everything I'm showing you is exactly what you would do within a day time frame. Exactly.